Welcome back to FT Markets. When the European Central Bank launched its quantitative easing or large-scale asset program, expectations were for a squeeze on riskier assets such as European corporate bonds. That certainly happened initially, but lately it looks like the juice has run out of the rally. With me to discuss what's been going on in corporate credit markets is Hans Lorenzen, who's a European credit strategist at Citi. Hans, welcome to the Financial Times. If we look at our first chart, we can see the performance of government bonds, investment grade, that's the highest quality corporate bonds, and high yield, that's the riskier corporate bonds, in two periods so far this year. Initially, up until the mid-April, we had quite an impressive performance, but then what happened?
Well, it's been a very interesting start to the year, hasn't it? I mean, effectively, you can see that the sovereign performance has gone from more than 4% into negative territory in just over 6 weeks. And clearly, it's the move in bonds that's been driving
There
this.
was a lot of volatility, wasn't there?
There's been a lot of volatility. You had very consensus positioning in the markets. Amongst some of the what I would call the more vulnerable accounts. So the fast money was the positioning was very consensus. The street,
Too much herd mentality.
The banks were long anticipating that everyone would come in that the real money would come in and that the ECB would come in and take them out of these very long positions. And what then happened, I think, in part, was that a lot of the sovereign issuance we saw this year came with much more duration. It was much more longer dated than people had anticipated. And so some of the real money funds ended up with more risk because obviously longer dated bonds have more duration.
And the whole thing reversed, you know.
And so the real money funds were not as desperate to buy as many as the fast money had assumed. And so then suddenly the positions start to become vulnerable.
Okay, and then we had that sell-off as well, which has obviously hit your returns if you had government bonds. What's interesting is that also investment-grade corporate bonds have behaved pretty similarly to sovereigns.
Yes, so you would see the returns you had in the first part in investment grade, in the first phase, was lower than in sovereign space. And that is because the investment grade market is not as long duration, it's shorter dated than the sovereign market. But in the sell-off, subsequently, you have had a sort of very similar move, plus you have had a bit of widening in risk premium in the investment grade space.
Was Greece a factor?
I think Greece is one factor, but equally importantly, I think the investment grade debt market has been hit with too much supply.
Okay, we're going to come back to supply in a minute, but just crucially, of course, in the high yield, the riskier products, we've actually seen a pretty strong performance still, even after the latest turbulence.
Yes, so high yield has really proven remarkably resilient.
Why is that?
Well, I mean, I think people traditionally associate high yield as being more a total return market, and that would normally make it more susceptible to movements in the risk-free interest rate, i.e. what you get in the sovereign space. But this time round, I think people believe that there is still value in the high yield space. It's relatively short dated. It underperformed in the second half of last year, so there was a little bit more yield there. And I think if you look at the flows, unlike the investment grade space where the flows have been disappointing in the last few months, in high yield we're seeing record inflows year to date.
So the European Central Bank QE is working. It is driving people into riskier assets.
I mean, it's working in that sense. I think that the conundrum is still, why are the flows into investment grade so weak? Okay. We did a credit survey a few weeks ago, and where we asked European investors, are you seeing inflows, are you seeing outflows? And the bottom line was that people were reporting the lowest level of inflows into investment grade funds we've seen in nearly 2 years.
Which is a bit bizarre when the European Central Bank...
Which is a bit bizarre when you are sort of assuming that the ECB is going to come in and distort the European fixed income market.
By buying government bonds. Let's look at our second chart, which goes back to that supply point you were making, because actually the net supply, when you look at the issuance by non-financials, banks, financial institutions, governments, and interestingly foreign issues as well, that's a little sub-story as well, it's actually been quite sort of modest. That presumably has had an impact on the performances we've seen.
Yeah, so if you had asked me 6 months ago what I thought about this chart, I would have told you, look, in 2009 the Eurozone fixed income market was growing at a rate of €1 trillion per year. Since then, the growth of the market has basically
fizzled out.
Fizzled out. It's been eliminated, right? You've had a reduction in government bond net supply because the fiscal deficits have come down, and you have banks that are on a large scale retiring securities. And then when you add the equivalent of what 700 billion of ECB QE per year, 60 times 12, you know, that red line, which is the net growth of the Eurozone fixed income market available to investors, would be right down here. So you would think that effectively in 2015 we're going to end up in a situation where people who are holding bonds today will end up holding cash tomorrow because the ECB has taken them out of those positions. And then the question is, well, how will that cash be reinvested?
So what's going to, last question, looking forward, what's going to happen then to the performance, you think, of corporate credit, investment grade and high yield then?
Well, I mean,
these pressures.
It's possible that that cash that needs to be reinvested is finding other places to go outside of fixed income, be it equities or be it global fixed income markets, i.e. US Treasuries or somewhere else. But we still think that a lot of it, for regulatory reasons and other reasons, will be relatively trapped within the Eurozone fixed income market. And so we're still expecting that there will be this squeeze down of money down through from the sovereign space into credit space. And for me, July will be a really interesting month to follow, because that's the first month in this period where we've had ECB QE where the redemptions in sovereign space turn really negative. So you have 100 billion of the sovereign redemptions in July alone, net.
So Hans, we're going to have to stop there. Thank you very much. So perhaps a further squeeze to come in European credit markets, which could help support performance.